I'm Brandon Sedloff, Managing Director of Juniper Square, and you're listening to The Distribution by Juniper Square. We're here on site today at the IMN CFO COO Conference in Dana Point, California. We're spending time with industry thought leaders who are sharing critical insights and perspectives about the macroeconomic environment, the impending recession, or perhaps lack thereof, and more broadly, how leaders are driving operational efficiency in their business. Today, we're interviewing CFOs, CEOs, and COOs to gain critical insights. I hope you enjoy this episode of The Distribution by Juniper Square and learn as much as I have. Eddie, thanks for joining me.
Nice to see you again.
Great to see you. Yeah. So here we are. We're at the IMN CFO conference. It's May 2nd of 2023. What are you hearing? What's on your mind? What have you learned today so far?
Gosh, you know what? It's terrific. First of all, anytime that you can actually gather up and kind of have a conversation with your peers, it's just a terrific outcome. Because no matter what happens, you're learning something, and if you're not learning, you're dead, right? This particular conference is very interesting because it's the COO and CFO conference. And I'm a CEO, but from time to time, I sort of feel like I'm not getting enough of the in the weeds from my competitors and peer companies. Right. So today I've spent a lot of my energy kind of meeting with folks and having some dialogue around some of the day-to-day business operations, which I'm actually well versed in my own company. I'm not a in the clouds type CEO. I'm in the weeds myself. And so it's important that I understand what other folks are going through. And there's misery and loves company kind of idea, at the same time. One of the things that I've kind of landed on is, well, if all of us in this sector are grappling with the same challenges, number one, it doesn't feel so lonely. And number two, it allows us maybe a little bit more freedom to solve the things that we can focus on. We're not going to solve the debt market crisis overnight, but we might be able to solve some of the business operations issues or some of the financial reporting issues that certain groups are feeling, or, the investor relations issues that certain folks are feeling. And so, with that, we're able to actually hone in a little bit more of where the problems that we can actually make an impact on solving.
So in your opinion, what are some of the problems that you think we can focus on now that we've established that a lot of us are suffering from the same set of problems and challenges in our business, and it doesn't feel so lonely once you start talking candidly with your peers?
Yeah, well, it's, I think, what it boils down to is communication. When people stop communicating, or they start hiding in their offices, or they're hiding, under their desks, or wherever they're hiding, they're not talking, and they're not communicating, and they're not communicating with their investors or their joint venture partners or their lenders. I mean, the day you stop this open communication and a culture of communicating, you may as well throw in the towel. This sort of time that we're in right now is it's not for the faint of heart. It's not for the inexperienced, and it's not for the folks who like to keep to themselves and try to put on a happy face and it's all good, everything is great. Everything's not great. We got a lot of real serious issues, some of which we're going to be able to work on, and some of which are out of our control. The interest rate problem is going to be the interest rate problem. Whatever that is, whatever that leads to, is something that the industry is going to have to contend with.
Yeah. And I mean, we can't control what the Fed's going to do with interest rates. Are they going to raise them? Are they going to hold them? How much longer? But I think one thing that I've heard a lot of talk about today at this conference in particular is the importance of relationships, right? So in relationships with your investor, give good news fast, bad news faster, but also the relationship with your lenders. What are you seeing, as you talk to lenders that you've worked with, are the relationships paying off, or is there some flexibility there? Or do you think they will if you haven't had to test it yet? Or kind of what's your sense?
Yeah, I think that relationships always matter. And I think that behavior matters. So if if you're the type of person that wants to, again, hide under a rock or start hiding the ball, that's going to come back to haunt you at some point. Our lenders, we have terrific relationships with them. There's not a heck of a lot we can do about some of the deals. If you've got a bridge loan that's been, whatever, securitized 9 times till Friday, there's not a lot you can do about it. The servicer is not going to make a special exception because you went to coffee or played golf with them. That's not going to happen. Right. But the transparency and the honesty and the integrity, that comes through. And so when we're faced with issues, which we've had plenty ourselves, we've figured out ways of working around them. Either we're rebalancing a deal, or we're buying a new hedge or something like that. We're doing something that is making sure that we're staying on the forefront, and we're giving ourselves time to execute, time to to improve the units if that was what our business plan was. And really it's all about trying to maintain that transparency and the communication line.
So we dove right into like the market fundamentals, what's happening here at IMN. You're the CEO of New Standard Equities. Tell us a little bit about New Standard Equities so we have a framing for this conversation.
Oh, yeah. Terrific. Yeah. Sorry, we just jumped in.
That's okay. That's so excited about what we're hearing.
I've known you for so long that it's like buddies. I appreciate that. Actually, so New Standard Equities, for those of you who don't know, we're about a 13-year-old firm. We've developed our processes and procedures out of sort of best-in-class learnings from all of the various large institutional type operators that are out there, household names. And we've put together an investments team and an asset management team alongside a property management team, fully homegrown. And we truly deliver a best-in-class, operating experience for our residents, as well as hopefully return-wise for our investors. We take a lot of pride in what we do. We aren't for everyone. We invest exclusively on the West Coast, so we're big believers in the knowledge economy in Greater Seattle and the Bay Area and Southern California, Inland Empire. We've got some nice assets. We're very much in tune with the West Coast and what's going on. Despite the political challenges of the West Coast, we still have a vibrant workforce. We've got a really high income earner in terms of our resident profile. And we truly believe we're delivering the best of all opportunities for what that resident is willing to pay and what our investors willing to invest. And we try to find that inflection point where we get win-win-win. And hopefully, if we're doing that, if we're doing our job correctly in any market, we're going to end up doing pretty well.
And so in terms of size and scale, number of units?
So we have about 1,800 at the moment. Okay. We've been as large as 29, 30, maybe 3,000 or so. Okay. I would love to get up to 5,000 in a year. I have a big appetite if anybody wants to invest. I've got a lot of opportunities that I see out in the market in our particular submarkets, which I'm very excited about. But we stick to our knitting. We don't fish in other people's ponds. We really make sure that we're local sharpshooter type experts in our exact markets. So with that investment discipline, we're not going to fit everybody's appetite. Some investors come to us and say, "Hey, we can't do California. We don't like the politics, or we don't like the whatever the du jour sort of reasoning is." But there are plenty that understand the supply and demand dynamics here, and the impossible supply problem that we have here, impossible to fix, given everything that we know about.
So we talked a little bit about investors, and yes, I think in a world where investor capital is abundant, there's a lot we can do. What is your take on kind of the current interest rate environment? That's been a conversation that we've heard talked about at nearly every panel. Obviously, interest rates are rising, but what impact is that having on multifamily, and in particular, multifamily in California and the markets that you operate in?
Yeah. So, great question. It's a great topic. Wish we weren't having that topic. I wish interest rates stayed low forever.
Yeah.
But they stayed low for super long time, and some would say they were way too low for way too long, and now we're kind of paying the price. But at the same time, maybe some of the good that's coming from this is a back to differentiation between markets. Maybe there's a reason other than interest rates to buy assets and to buy and invest in multifamily. Maybe you're really following along in the tech space, for instance, and you believe that Silicon Valley is still the mothership of all tech innovation in the world. And if you do believe that, maybe buying a multifamily asset in that market is a great idea. I particularly think, yes, that's where you want to go. But, I think interest rates are what you're paying today for the opportunity. And okay, so maybe it's, maybe you're paying 5-6%, maybe it's 7%, maybe it's 8%. Cap rates ought to come back to the sort of revert to the mean eventually, which means maybe you're at a 5 cap today, maybe it's a 6 cap tomorrow, but in 2 to 3 years, it's probably going to be back in sort of reverting to the mean. Let's just say in the Bay Area where you're at 4.5. And if you're at a 4.5 and interest rates are 5 or 4 or 5.75, whatever that is, and the stuff that we invest in is all value add, so we're hoping to improve that income. Ultimately, you're getting to about the same interest rate and cap rate dynamic that we've always seen, which is, usually it's somewhat on the rim, but it's either positive or negative, and you kind of deal with it on a case-by-case basis.
But until we get there, there's been a lot of conversation. I think we were talking about it on the floor earlier about cash-in refis and portfolio recaps. I mean, what are some of the tools at your disposal as you think about kind of working through the current environment?
Yeah, it's great. We have some assets where we had floating rate loans and rate caps coming due, and we were able to actually refinance to a fixed rate product, and we gave cash back. We just returned, I want to say $6 million, I think, on 3 different assets to our investors. So that was a great win.
That's great.
Other assets, we're facing some capital calls. That'll be a little bit of pain, but we're basically saying, hey, we can actually buy a interest rate hedge. And it's really prepaying your interest, if you will. And hopefully interest rates come back down a little bit. But depending on where you are and where that investment is, we've been able to actually move our rents to accommodate that rising interest rate cost. And then, it doesn't leave a lot left for investor distributions, and we call it distribution, but it doesn't leave a lot right now for distributable income.
Right.
But we've been able to pay our debt service and pay our employees and keep the lights on and keep the engine going. And we hope to be able to continue that, whether it's through capital calls and paying down some loans, or buying a rate cap, or refinancing the entire thing. So hopefully the assets that we purchase and that we're in are quality enough to kind of ebb and flow with us, that we can mitigate the capital stack pressures.
Right. Yeah, I think somebody said earlier that real estate is not worthless. It's a resetting of the capital structures that have been established that work for the old environment don't necessarily work for the new environment.
That's right.
So when you think about, you've got one side of the equation that we have no control over. You have interest rates, you've got the macro environment. Nobody can control the Fed as much as people want to try or even guess what they're going to do. The other side, you have operational efficiency, right? A lot of CFOs and COOs here are talking about the middle and back office and operational efficiency. as a CEO, how do you think about kind of operational efficiency in your business as a way of bringing costs down,
Yes.
or getting more out of your employees, whatever it may be?
It's an interesting topic, especially the way we're structured. We are fully vertically integrated, so we do our own property management, asset management, accounting, construction management. Uh, we're doing everything we can to service that resident and their needs, as well as the needs of our investors and the needs of our employees. So we're really trying to find that perfect balance all the time. Um, if we can find operational efficiencies at the site level, we'll make that investment or we'll make that change. If we can find operational efficiencies at the corporate level, we'll go ahead and make that change as well. Nowadays, we're looking for ways of implementing sort of a centralized kind of function in some areas of our company, and in other areas, we're seeking more specialization. So whoever we can find to join us usually winds up being cross-functionally trained. So we actually have, folks that are asset managers that used to run buildings in the property management space, and we have construction managers who used to, run buildings, or we'll have accountants that used to be, work on site, or and vice versa. So we're really trying to find people who can wear a lot of different hats and contribute in a collaborative way across the spectrum of the business.
So as you look forward over the next 6 to 12 months, what are you most optimistic about? And then what is keeping you up at night?
Well, the further out we go, the more optimistic I get.
Good.
So that's key. If you look at our industry, particularly on the West Coast, we're not building enough housing. It's a huge social problem, actually, to be honest.
Right.
We're asking a lot out of our existing rental stock in terms of supplying the correct kind of housing that our people need. The government is not doing us any favors with regard to lack of construction and lack of affordable housing alternatives. And it's unfortunate on that end. But on the multifamily side, for a market rate operator, we can just do what we can do.
Right.
But when you look out far enough, you realize that at least on the West Coast, that fundamental dynamic has not changed and it won't change. So what I see in the future is a greater demand on our housing, and with greater demand, that means the prices are going to go up. With prices going up, there's an opportunity to ethically make money. And by ethically, I'm saying we're going to continue to supply quality housing. We're going to ask a fair price for the product that we're offering. And we're going to hopefully do it in a compassionate and thoughtful way. If we fail at any of those things, so be it. We are definitely trying our best.
Right.
But that doesn't really answer your question in the short run. So in the short run, there's a lot of pain. There's a lot of challenges. We haven't purchased a new asset in a year and a half now, and that's because we want to be really, really sure that we can do what we say we're going to do in the sales market and the buying market. And I want to make sure that it's the right underwriting for where I see the risks to be. And we've just now, in the last, call it month to 2 months, have seen some stuff that I think would actually work pretty well and make pretty darn good investments, especially on a risk-adjusted return. And I think that that's going to, start to loosen up a little bit, and we'll see more of that stuff come out. I'm not really super interested in mining lenders stuff that they've had to take back. Usually, at least at this point in the cycle, it's some kind of not so pretty things that they've got. And I'm interested more in things that are sustainable to reach that long-term horizon that I talked about.
So very bullish, deep thesis on California at a micro or kind of regional level, which is where you operate. The national headlines are such that it would lead you to believe that California is going to have zero population by the year 2050. We're talking about supply constrained market. We're talking about rental rates going up. Wages need to go up. The Fed's trying to keep wages low. We'll see if they're successful. Do you have any concerns about kind of the workforce, or how do you see that shifting in California? It's compounded by, COVID to current macro.
Yeah, the COVID thing is crazy bananas. I mean, there's no other way to put it. We just now are having our moratoriums.
Yeah.
Anyway, we're just now having those lifted in some of our markets.
Wow.
Crazy. Yeah.
Wow.
It's like COVID is finally coming to an end, which is a great thing. By the way, not just for the landlord for collecting the cash, but how do you operate a building for the 75 or 80% of the other people that are paying their rent?
Right.
How do you operate that and give them what they deserve when you have a 20% hole in your income?
Right.
So it really is, unfortunately, for those folks that aren't paying their rent, it's impacting the whole. And those folks ought to think about the rest of their neighbors, not just the landlord. It's not a landlord or housing provider versus resident sort of dynamic. The world needs to come together and realize that, hey, it is time to pay the rent because everybody needs to be taken care of.
Right.
And it's really hard for us to do that with that whole. So aside from the COVID dynamic, it's hard to really explain my perspective. I was born in California. I think, and now I get to say I'm of a certain age, but I've been hearing about California falling into the ocean literally since the 70s, so even I think it was Superman, the movie, a nuclear bomb was going to hit the San Andreas and knock off half the state. So California is not falling into the ocean. We have our issues. We have some problems, but we have the greatest economy. Literally, I think we're the number 5 in the entire world.
Right.
Even people talking about leaving, like, oh, people left. It's like, they didn't really leave. If you look at the Bay Area population where you guys are... It shifted. But the Bay Area actually expanded from 2019 to 2023. So through COVID, through the remote working and all of that, and through the exodus out of San Francisco and now back to the work, it's actually expanded. So we have more people living in the Bay Area than literally ever before. And that sort of dynamic exists across the spectrum in our major metropolitan areas.
Right.
And so, yes, we have some move outs and we have some shifting and whatnot, but California is a huge state.
Yeah.
And you unfortunately, there's a lot of traffic. We haven't felt anybody, socially or comfort wise in our cars. Like, oh, good. Now we're like empty. We're not empty.
No,
we're
roads
packed.
Are full. Yeah.
Roads are full.
Yeah, I feel it
restaurants are full. It's impossible. Everybody's doing pretty darn well here. I shouldn't say everybody. We're doing well, and we're going to continue to do well. It's just a challenge. It's a challenge, but we've seen it before, and we will continue to mitigate those challenges the best we can. And when folks are going out in other parts of the country, they love to talk about California this or it's bad stuff. Blah blah blah. Everybody has their issues. Everybody has some, whether it's the cost of your real estate taxes in Texas or your insurance in Florida. Everybody has problems. Everybody's got issues, unforeseen, and you just got to become the market expert in your area, and you can mitigate the lion's share of those risks.
So I know we're almost up on time here, but in closing, any predictions that you have for 2024? I know it seems a ways off. We're sitting here in May, but what does 2024 look like?
So I honestly, I think we're going to have a little bit of a recession at the end of this year. I think it's going to last 8 months or so into middle of 24, maybe toward the end of 24, and we're going to come out of this. And by 2025, we're going to all wish we had bought in 2023. So my goal and my role as a CEO of a multifamily investment company is to explain to investors that now's the time to move. Now's the time to refinance, acquire, do whatever we can at cap rates that feel pretty fair right now. When you look back at this year, at this point in time, in 2025, everybody's going to wish they were us, buying whatever they possibly could, because 2025 is going to be a banner year.
Well, on that note of optimism, Eddie, thanks so much for joining me.
Yeah,
I appreciate it. It's great to see you as always. I'll let you get back out there.
All right. Take care.
Take care. Thank you.
Bye-bye.
I'm Brandon Sedloff, Managing Director of Juniper Square, and you've been listening to The Distribution by Juniper Square. We've been coming to you from the IMN CFO COO Conference in Dana Point, California in May of 2023. Over the course of the last few days, we've had the opportunity to learn from industry leaders and get their perspectives on what's happening in the market around interest rates, the recession, and how to build operational efficiency and resilience into the markets. A few of the takeaways that I've observed are that, number one, real estate still remains fundamentally a people business, and your relationships with investors and your lenders matter. Do the right thing. Second, we are a very optimistic bunch, and by and large, most people believe that things will get better. It's only a matter of time. And lastly, we need to remember that real estate fulfills a critical need in society to be the place where people live, people work, and people play. So while the macro environment remains uncertain and nobody can control what the Fed is going to do, the outlook for commercial real estate remains bright. And for those firms who are focused on the fundamentals of asset management, driving operational efficiency, focusing on their core competencies, they will survive, they will thrive, and together the industry will emerge stronger than ever before. Thank you for joining me and listening to The Distribution by Juniper Square. If you want to follow along, you can follow me on LinkedIn under LinkedIn /B Sedloff or on Twitter @B Sedloff.